So, first of all, I just like to define emerging markets because it's used as if emerging markets are a homogenous sector. And the reality is, if you buy EM equities, you're basically buying 5 countries, and it's as concentrated in AI as US equities. And if you buy EM local currency debt, you pretty much buy about 20 countries that have liquid local markets. But if you buy EM hard currency debt, it's a constrained index. No one country is more than 7%. It's very diversified regionally. You can buy 80 countries. And the reality is, what most people don't realize, since 2003, EM hard currency debt has outperformed similarly rated debt in the US. EM local currency underperformed, EM equities underperformed. EM hard currency debt has been consistently outperforming. EM corporate hard currency debt is actually some of the best risk adjusted returns, not only versus fixed income, but also versus equities. So that is something I think most investors don't really realize. And then what happened over the last couple of years? EM outperformed during a trade war, including local currency debt and equities. It outperformed when the market was going down, it outperformed when the market was going up. We had a Middle East conflict and rates rose. EM hard currency debt outperformed similarly rated debt in the US. And so, why is emerging markets consistently outperforming in the last couple of years? And the reason is that there actually have been structural reforms in EM. Emerging market countries have improved fiscal discipline. They've had better monetary policy than developed markets. After COVID, they were the first to raise rates, so inflation went down most dramatically in emerging markets. And that has not been ignored by rating agencies. So the upgrade downgrade ratio over the last couple of years for emerging market countries has been the best among the last decade. There has been zero defaults in emerging market sovereigns since the end of 2023. And this improvement is not limited to the sovereign space only. Corporates have also been reducing leverage, particularly the higher rated ones, and they have also been reducing their default rates over there. So that's the fundamental picture. But the reality is, when there's a risk off, do fundamentals really matter? What has sustained emerging market performance even during risk off periods is the technicals. Unlike most of the sectors in fixed income, emerging market has been actually reducing issuance. Companies have been deleveraging. So basically, you had negative net issuance out of EM for several years. Last year was only slightly positive. And here I would sort of debate Marvin, because we've been seeing flows into EM funds, significant flows starting 2025. So money has been going into emerging markets. So you have all this supply coming in, demand coming in, very limited supply. And at the end of the day, you had investors come into 2025 with very low exposures because you had 3 years of outflows out of EM debt funds, which actually I've never seen in my career. So, this combination of fundamentals and technicals have really made emerging market some of the best performers over the last few years. Now, going back to your point is, why is there this perception of EM being riskier? The reality is emerging market countries have much lower debt than developed markets. So on average, EM country general government debt 70%, developed market 110%. If you look at the growth, consistently better growth than developed markets, 2% higher on average. And even with the China slowdown, which I was used to be asked about every single panel I was on before COVID, EM growth has been sticky at 4% the last few years. So they've managed to navigate that also. But there is always been this perception of riskier environment for emerging markets because institutions are weaker. That is a reality. However, developed market institutions are also weakening. So the convergence, unfortunately, is happening that way. So EM always had better credit fundamentals, technicals. The institutional convergence is happening by DM institutions deteriorating. And that is really making emerging market really not much different, better valuations, and really becoming an attractive destination. On US exceptionalism, I think everybody here thinks the US equity market's done fairly well this year and last year, right? Number 58 in the world last year, number 32 this year. It is not exceptional. Debt markets, as I mentioned, EM has been outperforming. So I'd like to know where the exceptionalism is.